Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is George Roberts. George is a real estate investor. He is the founder of Roberts Capital Enterprises, which sponsors value-add multifamily opportunities for qualified passive investors. In addition to owning over 550 units in active multifamily investments, he is also an avid passive investor as well. And he includes 600 multifamily units in his passive investment portfolio, as well as car washes, early stage companies, as well as triple net real estate. George is also the host of the Foundery, which is where leaders are forged daily. It is an award-winning podcast devoted to the roles of entrepreneurship, leadership, and mindset in success in the commercial real estate space. And prior to George being in the commercial real estate space, he was an award-winning data scientist and bioscientist with over 800 citations in the field of genomics and microbiology, as well as physiology. So, George, I am looking forward to the episode here today.
Yeah, looking forward to it as well. Very good to be here. Thank you.
Yeah, and I like to always start really with your background, where you grew up and what eventually led you into real estate. And, I'd love to hear a little bit more about, what you did in the world of science and stuff before that as well.
Yeah, so really busy life. So I've grown up in southeastern Michigan, had the beauty of the Great Lakes around me my entire life. Early career in bioscience. I had the opportunity to publish in 3 different fields. That was very exciting, but didn't really give me a whole lot of freedom. So, that's what we're here to talk about today, financial freedom. So I had to go into a couple of other careers before I finally figured out what I really wanted to do when I grew up. So then I became the award-winning data scientist, had the opportunity to take a look at a lot of investments. I decided to take that analytical firepower and ask the question, where should I invest my dollars? I came up with multifamily real estate. And so then I embarked on my current career as an entrepreneur.
Okay, fantastic. And so you mentioned not having a lot of time in your prior career. And I think that's what shifts a lot of people, or at least at some point, a lot of people find real estate in search of just that, right? That additional time, or maybe, looking to get out of something where they're trading their time for their money. But tell me, I guess, a little bit more about that specific, shift in your career.
Right. Yeah. So for me, being a bioscientist, it was extreme. You're expected to be there, whatever it takes, daytime, nighttime too. So it was a total mindset shift for me. The idea that I can make money and not actually have to be there supervising these experiments. For me, what really helped me with that mindset shift was my sister. She decided to launch a construction company, and I came along for the ride on the early days. And, it really didn't take much. Didn't take long before I realized that as much as I loved my tech career, being able to build something of your own was just so exciting that it didn't even feel like work.
Yeah, no, that's great. And so she was doing construction. What type of construction was she doing?
Residential construction. And in fact, we just finished our first subdivision, major milestone, built that in beautiful Troy, Michigan and Oakland County. And just so happy to be through that first project and looking forward to what's next.
Okay. And so she was doing residential construction, rather.
Residential construction, yeah.
Yeah. And then, so how were you exposed then to multifamily? Had you already done some investments before leaving your...
Right. Yeah, good question there. So I was a landlord since 2010.
Okay.
My father suggested it was a great time to sort of move up in the world and purchase a larger home, the one I sit in right now. And it was not easy on a scientist salary. Trying to think back to that time. Yeah, postdoc, not a whole lot of cash, but he pointed out that you're never going to have this opportunity again. So when I told him, I'm going to have to sell the current family home to have enough money to do this, he said, no way. You're going to make it pay for itself. You're going to be a landlord. So, that was, again, another interesting mindset shift to me, because being totally in my tech career and having literally no time for anything else, I really wasn't thinking about investing at all. But when I realized the cash flow was there, and it really wasn't a terribly difficult investment to manage, one single family home.
Yeah.
It got me thinking. So then later on, when I decided, hey, this world of entrepreneurship is a lot of fun, but unlike my sister, I really don't want to give up my 6-figure plus career and pursue that full time. I thought, why not multifamily? I mean, everybody tells you, hey, it's passive. I mean, it's mailbox money. I mean, gosh, you have the property managers and they do everything for you. Well, that's partly true. You can't have a lot of things done for you. And if you just focus on acquisitions, deal making, focus on running the asset, you can have a very nice lifestyle. And I still do that. I'm a passive investor, but I also actively own a few apartments. And, I have some duties there. But again, it's nothing that keeps me from doing whatever I want in the middle of the day.
Yeah, for sure. Yeah, that's it's an interesting thing. So when you invested in your first multifamily, did you invest as a limited partner with somebody else's syndication? And if so, how did you run across that? One of the things that I find is this just seems like not everybody is aware of that there are these opportunities out there, unless they get exposed to it somehow.
Right. Yeah. So I kind of went the obsessive YouTube channel route, podcasts. And so after I found out about it, I actually did make my first investment as an active investor. And, there's nothing wrong with doing that, but it didn't have to be that hard. I will tell you, if you're out there debating, hey, I'm a hands-on sort of person, I want to manage my own. I learned a lot more from each of my passive investments than I would have expected. So they're gonna reach these stumbling blocks or speed bumps along the way, and if they're a good operator, they're going to give you a lot of information about how they overcame these issues. So I just jumped into the deep end, but you don't have to do that.
Yeah, for sure. Yeah, it's funny. I look back on even my own investing career, and I probably would venture to even say I might be ahead if I just would have, invested passively, because there's a time consumption of doing it actively, and the learning hurdle that you're going to have inevitably with getting into something new, and those are all great lessons, and I wouldn't trade it, but I look back and I kind of wonder. You mentioned something as well, about your dad kind of encouraging you not to sell your primary home or your initial home, as you went to go get a different one. And I think that's great advice. I recommend that to so many people that, everybody wants to use the equity that they have in whatever home it is, but if you really think about it, like you put it, right, it's a very easy to manage situation where you've got one tenant at a home, you're on 30-year debt most of the time, and even when you go into the new one, it's the lowest down payment that you'll make on a real estate investment, right? For your initial home, or it can be. You obviously can put as much down as you want, but it can, it's very inexpensive money. You can put very little down and buy your next one. But yet, if you maintain the one that you've bought and you have some equity in, you get the principal pay down. I mean, it's an investment that just sits there and it appreciates and does very, very good deals for you. So I think that's smart to be able to hold on to that. But tell me a little bit about, you mentioned you did your first multifamily actively. Tell me a little bit about what it was. What was your initial investment that you made on multifamily?
Yeah, so this was a lot of fun. We found a 14 unit in Orlando, Florida. I live in Michigan, so this was, quite a distance.
Yeah.
I had a partner, though, who was willing to move down to the property, and he's also the one with the construction talent. So that just worked out perfectly. Having the right team was huge. But one of the other things that I liked so much about this first investment is we all put in $90,000. Okay. And when you think about multifamily, a lot of people have the idea that, well, this is big. How can I buy an apartment?
Mm-hmm.
But if you buy a smaller, like talking 5 units and up, and you buy something that's a little bit run down, something that could use a little polish, you don't necessarily need a whole lot in terms of down payment. And the sticker price was $800,000. We got seller financing. So there really were essentially no loan associated costs, no friction to the transaction. There were no covenants. We were at 50% occupancy for a while because we were just tearing through the renovations. We did all these things that people think you can't do, right? I can't buy commercial real estate with seller financing, or I'm not rich enough to do it. And my first experience really busted all those myths.
Yeah, that's great. And one of the cool things about seller financing, in most of the time, I mean, unless the seller just requests it, it's non-recourse debt as well, right? So here you have an opportunity.
Exactly. If we had gotten in over our head, or if something was wrong, foundation cracked, sinkhole opens up, heaven knows what goes wrong with real estate investments. Things can go terribly wrong. And yes, that was huge. And we actually, here, I'll tell you a story about seller financing and non-recourse debt.
Yeah.
So I also bought another property, which in our LOI, we insisted was going to be non-recourse debt, seller financing. Signed the PSA, same. We get the contract back. This is why I have to read contracts. It had to be like the worst recourse debt that I've ever seen. So I had my lawyer redline it, and we were like redlining, going back and forth up to the closing table. So, seller financing is a great thing, but yeah, you definitely do have to be very savvy.
For sure. Absolutely. And the closing costs and everything associated with seller carry is just so much less than normal debt. So
well, yeah, I mean, when I did my first agency loan, actually the same property, and I want to say that our closing costs were close to $100,000, right? I mean, we think my initial investment was like 90. Our closing costs were 100. Some of that was prepaying our insurance through the year. But I mean, wow, most of that was money that we're never going to see again. Yeah, it's amazing. If you have the opportunity to pursue seller financing, and you know the drill. I mean, speaking to your listeners now who may be a little greener, that when you talk to the broker, like, seller financing, like, what? You don't have the money? Like, what? I thought you don't have the experience. What are you guys new? Like, they always do that stuff to you. But you know what? You see a property that's been sitting there for a few months. There's a reason. Yeah. It may not qualify for nice agency financing, or maybe they want too much for it. Really, ask and ye shall receive.
Yeah, that's a great point. So tell us a little bit about that first one. You bought it for $800,000. Sounds like you do or did refinance it at some point. Tell me a little bit about the turnaround and maybe some of the lessons and experience that you learned from that first one.
Yeah, well, it was possibly one of the best deals I ever did. We had a great deal going in. We had our construction managed in house. Uh, let's see, rents more than doubled. But
Mm.
then look at interest rates, also more than doubled.
Yeah.
So how do we survive? Well, a couple things. First of all, I was able to help out with a construction loan. That's huge. So again, no covenants, and I do the books, so I know I'm going to get paid. Unlike a lender who is going to get really nervous if they don't like exactly what they're seeing, and they've got a list of rules engine that they've got to follow. If they don't do that, they're out. So despite the interest rates literally precluding our strategy of refinancing out all of our money, we still did great. The thing cash flowed, almost from day one,
Hmm.
except when we were at, say 50% occupancy. Uh, I can't say enough good things about it. I mean, we picked a property where all the properties around it had been improved, but there was just one 14 unit that apparently wasn't big enough for the big fish. So when you see that deal that you think is too good to be true, you have to ask yourself why. And if you get down to the last question, which for me is like, okay, maybe it really is this good of a deal, and maybe it just isn't big enough for the big fish. But at the same time, 14 units, it's way too big for a lot of people who maybe have one or two single family units and they think, I'm way beyond my depth here. So
Yeah.
that's sort of a niche where it's too big for most investors, but way too small for, people who are institutional or who are already, say, multimillionaires. Boom. There's a lot to be said for that sort of a niche.
Yeah, for sure. And so this one was in Orlando, and so it wasn't necessarily in your backyard. How did you find this one?
So it was my partner, and the funny thing is that he has a son who's an evangelist, and he'll talk to people in Africa and really flat country. He can talk to like it's like Woodstock.
Hmm.
They get hundreds of thousands of people out there, and so it was right next to his to his center. So they would all train their people down there in Orlando, and he wanted a way to see his son. So he just thought, I'll just start looking for property around here,
Hmm.
and we found this area that's kind of rough but a little bit improving. So it was interesting that it really came out of completely a personal story.
Yeah, that's some of the best ones come out of that.
Yeah.
So that's fantastic. And so you bought the 14 units. Now you're in the multifamily space. And what was the next investment that you bought from there?
Yeah, so for me, I happened to be in YouTube. It was LinkedIn Challenge.
Mm-hmm.
And some of the people in my group liked me, and one of them had this deal, required a lot of capital to close. So when they said, "Hey, can you raise capital?" I said, "Well, I've never done that. My only multifamily deal is one where we had three partners. We did it as a joint venture." Well, this was an assumption. So they had this amazing interest rate in 2021. Even for 2021, I want to say it was like 3.65, whatever it was. It was just beautiful. And the only catch, though, is that the property had appreciated since the owners had financed it. So if you want to do that assumption, first of all, it takes a long time, obviously. And second of all, you have to bring a little more capital to the table. So they were actually willing to trust me as a first timer. So I got in that as a co-GP and really got to learn the ropes of syndication. So that was really beautiful for me. And then the same month, I closed one as a GP. So the first group of people that I worked on to get that JV deal in Orlando, a different member of that group brought forward that deal. And that probably turned out to be possibly the best deal that I've ever gotten in. So,
oh, wow. Fantastic. Yeah. And so how big were these then? The one that was
so in order, it was 14, 104, and 34. So again, I really like the small niche because that small to mid-sized niche, you can find a lot of those in tertiary markets. Mm-hmm. You don't have as many people looking there. There's a lot more fragmentation. You're much more likely to get mom and pop than you are with a major metro like Atlanta or DFW, all these places that all the gurus are telling you to go. I mean, because, hey, they've survived for, 5-10 years to get where they're at. But if you're, still young and scrappy, I think, there's so much value to be found in these mid-size apartments.
Okay. And so tell me a little bit about the capital raise on that one. You hadn't raised capital before. You have a little bit of experience in multifamily with your first one under your belt. And what did that look like from a capital raise? How much did you have to raise, and who did you raise from?
Yeah, exactly. I want to say that it was $4 million raise, and I was still building my network. So I did a lot of things. I think at that point, I already had a podcast. I had been a guest on podcasts. I made all sorts of material to go out on, YouTube and this and that. Wow, getting your name out there, as you know, Keith, it is a big deal. It's not easy to produce content, to do it consistently, and to produce it of a high enough quality to attract investors. So I would say attracting capital is probably not my strongest suit. There's a lot of things that I do. I have a financial background. I like dealing with financial markets. I do like to raise capital. I like the asset management aspect of it as well. I like a lot of things, but yeah, it was kind of hard for me. But again, I was a really small partner in that co-GP deal. And then the third deal, that was a small deal. So I also raised some capital for that. I do take pride in bringing capital to each of my deals. I think that it's one thing that everybody should do some of. It's great if everybody can bring an investor or two. So, yeah. So what was it really like? If I'm going to describe it in a word, hard.
Right. Yeah. Okay. Okay. And so it sounds like the second one, and I don't know, maybe the third one as well. Were your initial investments in the multifamily space primarily in Florida?
So the first one was, and I think going into order, maybe the fifth one was. What happened is, by the time I got into Florida in 2020, South Florida was completely ridiculous in terms of prices. Now, I would say Central Florida, which is where the first investment was made, that's kind of crazy. Now I'm thinking, if I'm going to invest again, either Florida's got to experience a crash, or it's going to have to be Northern Florida. Yeah. I mean, there are some places like the Panhandle where I think there could be some really great deals. There could be a deal in some pocket, someplace, maybe some mom and pop operator. But, I've really been chased out of the South. A few years ago, the drumbeat was the Southeast. Well, I'm proud to say that I was really early days in moving a good bit further north. Now, I would say that the middle latitudes of the country is where things make sense. Kansas City is booming. Cincinnati looks great. I've done a couple deals in Kansas City, looking to do another one there. Elsewhere, I've got properties in Kentucky and Louisville. And then that third deal I mentioned, that's in East Tennessee, which just literally has been booming like crazy. Knoxville taking a little bit of a hit here in 2025, but that tertiary market is still doing wonderfully.
Yeah, yeah. And when you say East Tennessee, where's is it in Knoxville, or is it?
So it's about 30 minutes east, and it's okay. One of the most beautiful places in the world. You've got Sevierville, which has some beautiful entertainments there. This town is basically owned by Dolly Parton. And then you've got the Great Smoky Mountains, and you've got Gatlinburg as well, which is just, it's a fun little place. It's a total tourist spot, but it's also very beautiful. Very beautiful.
Yeah, for sure. Yeah, Smoky Mountains are really nice. We have a place in Whittier, North Carolina, and it's just near Bryson City, but it's kind of south of like Knoxville, and it's still in the Smoky Mountains. It is beautiful up there. We don't get up there quite enough. But.
Yeah, I love the Carolinas too. I mean, they're just booming right now in terms of percentage population growth. You can't beat the Carolinas right now.
For sure.
So yeah, another great example of those middle latitudes. It's not the deep South Sun Belt, and the North is still in many ways, unfortunately, the Rust Belt. But yeah, some of those places in the middle band of the country, the Carolinas, great places to invest.
Yeah, for sure. And one thing I don't see there as much, and I'd be interested to hear about your experience with it, but, in Florida, and, I got investments in Texas, we have, huge property taxes, right? So, I mean, the property taxes is incredible compared to what, our place in North Carolina has, next to nothing on property taxes. So I don't know. Do you experience that as well? Do you see a big difference on that? How much you have to allocate towards the property taxes themselves?
Yeah, for sure. I mean, I haven't gotten eaten on the property taxes so much. Tertiary markets, being open to that and having some deals out there in those tertiary markets, that does help as well.
Mhm.
The one real thing that I have been eaten up on is insurance. Florida has just been crazy on
For sure.
insurance. And now when I tell my friends, hey, my last renewal in Florida was significantly lower. I want to say it was about 30% lower. And we got the same quality of insurance too, because we got an agency loan. So, they're very
Mhm.
stringent. So when you go and you show the proof of insurance and you say, hey, I need these things, you got to match this. And we came in, like 30% lower. That's huge. So, wow, where do I want to go with that? Reserves. Make sure you reserve for everything, because things go wrong with real estate physically. Things go wrong with real estate in terms of the business climate, such as insurance, and things will go wrong in the economic climate, like people just getting thrown out of work. So I'm a big fan of telling people that make sure you have adequate reserves both in your business as well as outside your business. You want to be financially strong as well, so that when it comes to it, and there are issues, if you have to have a capital call, you want to be able to answer that. It's not good to have to go back to investors, and you never want to lose a property. If you can hold on to your properties in real estate, you will almost always make a profit.
Yeah,
It's always, in other words, it's the leverage that kills you.
Oh, for sure. No, that makes a lot of sense. Yeah, it's crazy what's happened with some of the insurance rates for sure.
Well, yeah, Texas, you're getting hit too.
Yeah.
Oh yeah.
Yeah, it probably not quite as bad as Florida, but certain parts of Texas for sure. Yeah.
Yeah. Florida's definitely the worst for insurance.
Yeah.
I won't argue with you.
Right. What tell me a little bit about some of the other investments that you've been doing, whether it be, Kansas City, whether it be Louisville, what else are you buying out there?
So just not a ton of multifamily. Actually, I got 2 in Louisville at this point. I'm doing all kinds of things. I'm doing lending. I mean, one of the observations I had over the last couple of years is a lot of syndications have really gone bad, or gone, at least to put it kindly, sideways.
Mhm.
And the lender always gets paid. It's rare that first position lien ever loses any money. And so just to kind of draw it all together, put a bow on it, if you can loan in the first position and get 12%, forget about what equity is making. Forget all that FOMO. You can do very well. And I'm at a point in my life where I can just lend my money. If I can get 12% or more,
Mhm.
I'm doing well. And if in the worst case scenario, I end up operating an asset because I have to foreclose, I mean, think about it. That's not a terrible place to be. If that's the worst case scenario, I can handle it. So I've gone to a lot of other things, private equity, still investing in apartments. And this may be a great time to do it. We're recording this here in the middle of 2025.
Mhm.
We've had 2 consecutive quarters of uptick in multifamily prices. You can check that out on Fred. We're going to get another data point in just under a week. And I expect to see that we're going to see probably a significant price increase. And so people who are able to buy right now, saw a deal just yesterday. Somebody had a nonprofit and they're selling their property. The nonprofit doesn't allow them to rent to anybody but their nonprofit for whatever reasons, maybe not raking in the cash. They don't have the employees. They have significant vacancy. And so that's the sort of deal I'm looking for, a special situation. So I don't want to give you the impression that I'm out of real estate. I think this is a great time to buy, but I'm just doing other things. Like you mentioned earlier, like how'd you find out about syndication? How did you get into it? Were you active? Were you passive? I mean, this is the reasons why I wrote my book, because I want people to not only understand that, yes, you too can own real estate without having to deal with the tenants, termites, and tantrums, but you can do other things. I invest in early stage companies as well. I like to play Shark Tank, as I call it. But,
Yeah.
there are a lot of things you can do that make similar style equity returns, and there are also things that you can do that are safer, like, for example, lending. So I'm a huge fan of diversification.
Yeah, for sure. What on the some of the lending? Let's maybe go back to that because 12% return is huge. And like you said, if you're the first position, it's backed by some type
Mhm.
of real estate. You're in a fairly safe position from a risk standpoint. What type of loans are you what types of properties are you lending on? Are they fix and
Mhm.
flips? Are they small multifamily? What is the lending
So
look
yeah,
like?
we've done a few. So yeah, small multifamily in one case because I was involved in the deal. I did one which was a fix and flip, and then in one case lending to an operating business. And all those are very potentially different types of investments,
Hmm.
but all with their particular upside.
Yeah, yeah, for sure. And as far as the businesses that you've invested in, tell me a little bit about that. What do you look for in a business that you're willing to invest in or potentially provide a loan for?
Right. Yeah. Yeah. For my first one, that was an equity investment that was with my sister.
Okay.
So I ended up being a 50% partner in that subdivision. And, that was fun and really eye opening. Learned a lot about the construction business, mainly secondhand. It was also very valuable. I mean, to make money is good, but to be able to help a family member is priceless. So I really was able to help her get her start, and my brother in law as well. So, that's beautiful to have that sort of family synergy. I mean, I'm looking for things that cash flow that are reasonably safe. For us, we self funded, so we had literally zero debt.
Hmm.
So unlike other developers, for us to go under on that development, I mean, we would have really had to screw it up badly. But on the other hand, it's hard to make a killing without that leverage.
Right.
And then, as for other operating businesses that I may be interested in, again, just a ton of cash flow. So some businesses are providing. If your listeners are interested in a book recommendation, I have more later if you're interested. But Cody Sanchez, I want to say it's Wealth on Main Street,
Hmm.
whatever it is. Look up her name. It's an amazing book. She bought a lot of laundromats and kind of graduated from that to other types of operating businesses. So many operating businesses are just making tons of money. Problem with the laundromat is that it can be a lot of work outside of technology or if you're in the wrong area, et cetera, et cetera. But yeah. I'm pretty open there. The main thing is that I want to kind of stay passive. So if I could buy a business the way Cody does it and hire a manager, that's totally okay for me.
Yeah, yeah, for sure. Yeah, it's a great book. I've I've listened to that one. I didn't read it, but I did
Yeah,
the audio.
I
And
know. Isn't that way we all are? I have too much to do. I am always buying a new audiobook, but print books, that's mainly for the technical stuff. I like those for like finance. When there's equations, I want to be able to pick that apart or a lot of steps to the process. It's great to go and actually take a look at those flow charts, et cetera. But oh yeah.
yeah, for sure. And so tell me a little bit about some of the businesses that you've bought. What type of business were they? And, did they end up being as passive as you were hoping or, kind of what did that?
Well, yeah. So with my sister, it turned out to be totally passive. I came in as an active partner, but I had a job. She quit hers, and then I went into multifamily. So that wasn't really. So then the only other one that I have gone into at this point, and that I'm really really interested in, is still kind of ongoing. Don't want to provide too many details about it at this point, but it's drug rehab, and I've always wanted to get into that because for two reasons. I mean, the obvious thing is you're able to charge per bed, right?
Hmm.
And there's
Yeah.
so many services, and there's 1,000 reasons why drug rehab makes a lot of sense right now. You have mental health is now on parity with our physical health, and so the government is paying for this. Whether it's your government or the private insurers, it's getting paid for. And then we had open borders for a long time, a lot of drugs coming in. Now I can't say the problem's been fixed, but maybe we're getting towards a solution for that. So we have a serious drug epidemic, and we have payers in the system. And at the same time, it's very difficult to run. It's like running, elder care facilities, that sort of thing. You have a lot of regulations. It really takes somebody who truly, truly, truly believes in it. And there really aren't a whole lot of people who are out there who understand the technical side of the regulations and really have enough love to want to do that. That sort of tough side and the love. So that's something I'm definitely looking into potentially expanding in the future, because, I mean, we just need it. So anyway, I mentioned there's two reasons. The other thing is that there is the sort of the social need side to it. Now, I don't want to put that up front because, I don't want to be a virtue signaler and say, like, I'm doing it just to help people. We live in a free market, and you can't make money by putting a gun to somebody's head. You have to provide value. So whatever you're doing, I guarantee it's providing value to someone. But this is one where it literally is life-saving. I mean, I've seen the people come in there, and I can't even begin to tell you the blank look on their faces. And, I hear them, talking and chatting like, how are things going for you, man? It's not okay, but, things are going to be okay. And you can see lives turn around. So
Yeah.
If I were to say that was not a part of it, as a human being, when I see that, that's huge. But I get the same thing from apartments. I mean, I took over an apartment complex where there was crime, people getting broken into every day. Like, I can't imagine what it'd be like to live in a studio apartment and have somebody break in and, probably I would have to imagine an armed robbery and literally standing over your bed. I can't imagine that, just installing cameras and putting them up on a post so that it's not easy to, throw stones or use them for target practice. Just little things like that, taking an apartment complex where people are literally in physical danger and turning it into a safe, clean, affordable place to live. I say for entrepreneurship, the possibility to impact lives is literally endless.
Yeah, for sure. And I've seen that myself as well, just where you take a property that, was run down, mismanaged, and you're creating now a safe place for people to live. They certainly do appreciate that. And I can imagine that the drug rehab would be very similar from that standpoint. On that, are these facilities like individual houses that you're talking about? And, is that something that can just be done in any neighborhood, or is there specific? I would imagine it varies from place to place, state to state, but just curious.
Yeah, well, just like senior living, there are just so many tiers to it, right?
Mm-hmm.
So you've got the sober living, which essentially is the apartments, right? You've got people in there. You have to monitor them because you're taking money and you're saying that this is sober living. Guess what happens to the ones that were non-monitored? I've seen the horror stories. They turn into the opposite really fast. So,
right.
That's like one level of management and regulation. And then you've got other things like the counseling and the peer support. So here you're getting to a certain point where, the government is saying, hey, we're paying for this. And, your program has got to meet for 3 days a week, or it's got to meet for 5 days a week. It's got to have these characteristics, and you've got to have a peer support specialist, and you've got to hire all of the staff, appropriate staff, and you've got to have your licenses. And then, another level is methadone, for example. You have people coming in for methadone. That's very dangerous. Further licensure required. You've got to have a doctor to supervise it, obviously. And let me see, what's another thing that I would mention about that is that you don't want to just run a methadone clinic. That was the advice that I was given by an operator. Because then the government comes in and they're like, well, what? You're just kind of taking money from these people. Are you actually providing any care? Is there any progress? Do you have any metrics? And so that's a good way to get shut down. So all of these things, as you see, are good. You could just do sober living. I know I have a different friend who's an operator who's doing just the sober living. And hey, if that works for you, that's great. But the higher you go up in the regulation, as you might imagine, there's a wider moat. And so then there's more protection. It's harder the competition decreases. So then you have things like partial hospitalization, where you have more requirements for medical staff. And again, I'm not an operator, so as I describe this to you, I'm describing it sort of from the standpoint of wanting to vet these businesses and invest either semi-actively or passively. And then you get to the detox, and you got medical detox, and people can actually die in your detox program. And now we're talking about the most serious level of liability, where you have to have your facility has very serious regulations, and the doctors, et cetera, licensure, the accreditation, all of that is up a few notches.
Yeah. And so in able to do that with a property, do you know any of the metrics as far as, kind of what you're able to yield from a rent standpoint compared to just if it was a traditional apartment?
Yeah. So, interesting as my understanding is that sober living can be very lucrative. For example, my operator that I know who wants to open one up in Texas, he expects that to be like, that's literally his ticket. I want to say it might have been a hotel before that, or it might have been multifamily, but really, really beautiful. And, he's going to do the high-end sober living. But another way to look at it is that maybe if for whatever reason you're not able to make a lot of money off of the sober living, it does help to support the other businesses. Because remember, then you have drug testing, and it's a moral issue, right? Some people will try to ding the facilities and say like, hey, why do you test them so often, and why do you send so many bills to the insurance? But if you don't do that, you're really operating unethically. So, having not every service necessarily adds a lot to the bottom line by itself. However, as a whole, through synergy.
Yeah, and so George, you've done several different investments, and some of the ones that you've done though have been passive investments, and I would like to hear a little bit about kind of I know it says that you invested in car washes as well. What are some of the other investments? You've invested in private lending, you've invested in multifamily, and it sounds like car washes as well. You want to talk a little bit about some of those additional investments?
Yeah, sure. I mean, I've kind of mentioned those already. I mean, I think early stage company is probably the most interesting thing. I invested in a fund and also in an apparel company, and both are doing really, really well, which you have to understand. Half of your investments when you're in early stage companies, you expect to go literally flat bust. So very gratified by both of those, and look forward to investing in others as well. I mean, when you invest with a syndicate, somebody who's willing to say no, I did the stats. I want to say that for every pitch that I see, the syndicate has said no 75 times already.
Okay.
And I think literally only of the pitches that I see, only half of those deals are going to close with this syndicate. So we have some really good statistics running. If you're willing to invest like that in early stage companies, you can probably see an IRR that exceeds just about anything else. Problem is you have a 7 to 10 year lockup period. And if you want to get the best returns, you've got to invest directly in each of these companies, which means you've got to invest, at least hundreds of thousands of dollars, and no cash flow. Generally, there's literally no cash flow. So there's a lot of drawbacks to it. I can't put all my money into this. But putting, a small to significant amount of money on the side of my cash flowing investments, I think it really makes a lot of sense. Car washes, I don't know. Do I want to talk about that? Maybe didn't go so well.
Okay.
Car washes, that was a passive thing for me. It was private equity, and they had some variable rate debt. They had, of course, the same thing happens in multifamily. Very aggressive. They had the thesis that in the Northeast that it was going to be hard to build new car washes. But then it turned out that people just weren't getting their car washed over the last couple of years out there as before, because they had the rainiest literally two of the rainiest years in history. So be that as it may, that's the story as was handed down. But, investment didn't go well, but, didn't end up in foreclosure either, kind of limping along. Hey, I would consider other things outside of multifamily in the future, but of course, only if I am completely passive. You got to stay in your lane.
For sure. No, I think and the reality is not every deal is going to go how you were hoping for it to go. And that's, there is inherent risk with investing, period. So, but I'd like George to give you some opportunity to talk about your book and tell the audience about your book as well.
Sure. So my book is Passionate Living Through Passive Investing. And it's really not just about investing. It's all about private markets. I want to make sure everybody has the opportunity to be exposed to diverse investments. So many things that most people haven't even heard about. I talk about even things like merchant cash advances, where you can make a lot of money as long as businesses are doing well. And then when the economy is kind of hitting the fan, those things tend to do really poorly. But I want people to understand there's literally so much to the world of private markets. And if you come into the world of private markets and maybe you say like, hey, I heard about real estate syndication. I like multifamily. Everybody needs a place to live. I agree. And that's where I'm at. But I didn't stay on that first square on the playing board. And it makes me sad when I see other people do that, especially when they have passive dollars to invest. And I see that there's literally no reason not to go out and diversify a bit. So I want to make sure everybody has the opportunity to be exposed to private markets. And the second thing is I wanted to talk about my life and my approach, which I think is a little bit different. I see so many people that are either, they're workaholics and they just work so hard and they tell everybody, hey, I love my job. I'm playing. And maybe they are. But I think you need to have some real play in your life too. And so I made a point of making sure that some of that passive income that's coming in, that I'm spending it in a responsible way that literally enriches my life. For example, I went to superprof.com and I found myself an in-person Spanish tutor for $10 an hour. Zoom, to be clear. And you can find opportunities like this too. I would have never imagined that I could have, literal conversation from an actual certified specialist, a professor of cultural history, teaching me about Argentina for $10 an hour. But that's the sort of thing you can do using the power of the American dollar and choosing a tutor in a foreign country that, maybe the economy is not going so well, where that exchange rate is huge. So that's what I would encourage everybody to do. I want to teach you how to invest in private markets. I want to teach you how to do it passively. If you're still at the active stage, which I am, I'm still working every day. I want to help you run your business better. Make sure you can do that, obviously not in a passive way, but make sure that you are taking advantage of things like virtual assistants. Make sure you're offloading as much as possible. If you're at the point in your life where you can afford a concierge, do that as well. Get yourself a housekeeper or a tutor for your children. All these sorts of things will improve your life immeasurably. To have somebody teaching my kids so that when I spend time with them, it's not just about the economics homework, which I love, but I can spend time just asking them, how was your day? Or saying, hey, what do you think about a hike this evening? Or, hey, you want to go in the kitchen and cook something? That's perfect. Show me what you're doing.
Yeah. No, I think that's great. It's, there's so many things out there that can just make life easier, and often just not knowing about them or knowing where to seek them out, is kind of the difference between being able to do it or not. So I think that's encouraging that you've got that information in your book. You mentioned a sailboat too ahead of the show. So tell me a little bit about this sailboat.
Okay, yeah, sure. So I bought her for $5,000, the Sally Mae. We were going to rename her, but my wife's best friend is Sally, so we ended up keeping the name. And the kids just love her. My son has been at the helm since he was 8 years old. That's my younger son. And my older son, he's a little more passive in his enjoyment. He just likes to go up into the V berth and open the fore hatch, and he just likes to be surrounded by the waves. And that just totally calms him down. So it was just amazing for us to realize that for a modest investment, less than what most people would spend on a new automobile, we had not only a new adventure sailing the Great Lakes, but we have our boatel. And a lot of times, particularly on the shoulder season, we might get charged $1.25 a foot. So that works out to $31.25 for a 25-foot sailboat. And we all have our own place to sleep. Not talking about the double bed at the hotel where kids are kicking each other. And by the way, they're way too old for that at 17 and 18. Right. One of the reasons why we don't take road trips as often anymore. But I mean, that's the idea is that, don't tell yourself, I'm going to wait until I retire. You don't know what's going to hit, whether it's health problems or whatever. But I want to tell people there's another reason that you don't want to wait to make sure that you're using your wealth to enjoy life. And that's because I find for myself, my vision for what's possible in my personal life expands every year. And I look at it like a muscle, right? This is something you work out. So if you're 30 with passive income, and you have this much, do what you can with that. If you're 40, 50, whatever the case may be, you want to spend as many decades of your life expanding that vision for your personal fulfillment and freedom.
Yeah, I totally agree. I think, oftentimes we're all fixed on this destination that we'll one day reach, and we don't enjoy the journey along the way. And I think it's important to recognize that. And I have to remind myself of that as well, where I'm just so fixed as to what, I'm aiming at, that I don't enjoy that walk and that journey along the way. So great advice there.
Yeah. Audiobook out today for those of you who are super busy like Keith and I.
Okay, fantastic. Well, why don't we go to that, George? How can people find out more about you? How can they, if they want to invest with you, where do they reach you?
So you can head out to www.robertscapitalenterprises.com or just send me an email at george@robertscapitalenterprises.com. All kinds of people I'm willing to work with, whether you're there for passive investing, which is obviously why I set up the website, or if you're looking for some mentoring. Happy to take a look at people's deals and tell you what I think. May or may not be willing to jump on board, but I remember when I was new, Keith, and one of the things I like the most about multifamily real estate is that people are friendly. I remember people mentoring me and telling me the sort of things that I would need to do to become successful. And I want to give back, and I'm still willing to do that. So active or passive, reach out to me. I would love to get to know you better.
Fantastic. And I've got two other questions for you, George, that I ask every guest. And one would just be, any advice you would give somebody who's maybe just starting out in their investment journey?
Yeah, be open-minded, because no matter how much nobody is too smart in this business. You're going to have to pivot. You're going to have to make changes, and whether that's pivoting from one niche in multifamily to another, or whether it's something more profound, like deciding that you want to go and pursue a new asset class. You want to keep your mind agile. Always look for counter evidence to your investment thesis. Write your investment thesis down and be willing to change it.
Yeah, I think that's great advice. How about a book recommendation? Of course, I want you to give an opportunity to just remind the audience of what your book is called as well, and where to find that. But then if you have another book recommendation, it doesn't have to be real estate related, but it certainly can be just something that's been impactful.
Well, we already talked about Main Street Millions, Cody Sanchez. My book is Passionate Living Through Passive Investing. My name is George Roberts III. And for give you a new book recommendation, one that you don't hear every day, I will tell you Marcus Aurelius Meditations. And the reason I would recommend that to anybody, business, personal, whether you're into fitness or whatever, is that mindset is everything, because it determines not only how successful you are, but also how much you enjoy your wealth. And I would say that Meditations is the finest philosophy book I've ever read. If you are involved in markets of any kind, you're going to be exposed to turmoil. And I think Meditations is probably the best antidote to the hustle and the bustle. Focus on what really matters. Focus on what moves the needle. Marcus Aurelius.
Perfect. Yes, very good one, for sure. Well, George, this has been amazing. I've enjoyed our time together, and I think we'll call it a show. Thank you so much for being on the Wealth Flow.
And thank you so much, Keith. It's been a pleasure.
Right.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.